Hello everybody, my name is Thor Young. I'm a moderator at Bearable Traders, and I would like to do a recap on my trade for you today. I've only done one trade today. It was a short on Apple. It worked really great. I wanted to talk to you a little bit about why I was looking at it and what I was thinking in this whole situation. First, one of the things I want to bring you to is we're going to talk a little bit about time and sales, as I said last week. But before I talk about time and sales, I want to talk a little bit about market making in general. And because in order to read the time and sales, and you have to kind of understand the greater picture on what's really happening in the background. So before I get into all that, if you have a moment, please throw me a thumbs up, please. I'd appreciate that. Subscribe to the channel, ring that bell, and all that good stuff. So now on to the trade. As you can see right now on my screen, I am in a trade on Apple. I took this trade about 3 minutes in. I have done one free roll add in that I'm now holding to try and get down to maybe somewhere around 147.50 if we get there. We're struggling a little bit down here at S3, but otherwise looking really good. So one of the things that I want to talk about real quick is the concept of market making. Now, there's a lot of misinformation out there about the goals of market making and what market makers do, trapping, all of these things. Now, inherently, these things are true, that people do get trapped, but it's not really the intention for that to happen as much as there's a process that goes on here that has to happen. And in order for certain amounts of shares to get exchanged, and if you tune into that process and start to understand that process, then you will start to read the difference between a trap and maybe a reversal. Volume being the big key here. So I want you to look at Apple here, and Apple at the open, notice I'm short at 149.30-ish, like 28.30, and using the high of my candle here. Now, if you're looking at this and you're just going to look at this as a pattern, let's get a little closer here. And let's say you're just going to look at this trade and just look at the pattern. What you would see is a large opening bar, a pullback on the second bar, and then a third bar breaking. Right now, innately, you would think, okay, this is a very bullish sign. So you're going to go long on the pullback here going in, and you're not going to quite understand why. You're going to take a stop out. But what happens is when this bar goes up, you get the consolidation, it pulls back. When this breaks, if you're reading the time and sales, you will see large buy orders coming through as it breaks. But what happened was the opposite. As the price broke, what I noticed is no large orders came in, right? Quite the opposite, right? The price action actually stalled, which if you notice how we have our average volume indicator going up, but our volume itself is staying relatively flat. This is what we call struggling volume, right? We have three types of volume that we're dialed into at all times. We want struggling volume, stopping volume, or advancing volume, right? But there's really only those three types that you can boil down to. So when we see this new break or this new 3-minute high coming, if the market maker intends to take the price higher, then what you will often see is a lot of large buys coming in at this new high. This will bring volume with the order flow, which will cause a breakup and allow the price to advance. You'll also see, like if you look over on my level 2, you'll see a lot of orders to the top side here on the level 2, which indicates strength, right? So, but what happens is we pushed up, our level 2 is fairly emptied to the top side. Rather, we had orders like this one here to the downside, kind of showing a pretty solid ladder. So once I saw us attempt to make that new high on our 3rd minute, and that attempt came with no volume, it was pretty clear the market maker, at least for the moment, did not have an intention of moving the price higher. Therefore, I shorted using a new high. We had no ladder to the top side, I had no market maker movement, which means I likely had no participation there, so I went short, new high, took a minute. Once we made the new low, the price dumped. I got a partial at 2-to-1, and then I started taking partials at profit taking on the way down. My target, which as I'm playing these, I'm normally looking to do something like a traverse. So I'm looking to play, likely between R3 down to S3, which is exactly what I did. I went short under R4, but my first target was under R3, and my main target that I was looking for was down at S3. And now I've added into my position here, and I'm looking for a move down to 148.50, where I've got some more bids. We had a large order sitting here just under 148, and we bounced off of it really nicely, but we still don't have any initiation to the top side. So I'm still feeling pretty good about holding this short. It would just be really nice if we had some larger orders to the downside to pull the price. So I'm not really sure. My average cost on this actually is probably up around 148.80, but if it goes through 148.52 or VWAP, I'm going to go ahead and call it a day on this one and cut the rest and take the profit. So I hope this has been an interesting lesson for everybody. The main thing you need to keep in mind as you move forward and start learning about trading is you need to understand that there are two primary ways of trading, both of them valid. One of them is trading off of what has happened. So this is where you're going to be trading off of fundamental indicators, key levels, daily levels, and then you can trade off of what is happening, right? Which is where you're actually looking at how well the market maker or the market making process is actually doing during a stock's movement, right? The best traders pair the two, right? You're going to look for fundamental key areas, special daily levels, previous day high, previous day low, but you're not going to trade them unless you see a volume indicator, time and sales indicator, or something on the tape that tells you the market maker is doing what you think they're going to do. Take those two and put them together, and you will find consistency comes a lot easier to you on a day-to-day basis, especially when there's an erratic market. I hope this was helpful for everybody. Again, thank you for hanging out with me. As always, everyone, keep it green. Thanks.